I'm Tim Hylton, equity strategist at Fiera Capital and a member of the global equity team. The last 3 months have been dominated by tariff talk and trade wars. Secondarily, there are concerns about inflation and rising rates. On the first point, trade wars are probably bad for pretty much the entire market, but in particular industrials and global multinationals. I don't think we've really been able to avoid that negativity. But on the second point, inflation and interest rates, our focus on companies that have pricing power, in other words, companies that can increase their prices as their input costs rise, has really led to strength in the holdings of our fund. So we've typically been underweight resources, and we don't own any energy or mining at this point, and those happen to have been two sectors that have been quite weak this year and certainly in the last quarter. So that's been a positive for the relative fund performance. We're also lacking exposure to the interest sensitives, in particular real estate, utilities, and telecoms. We don't own those as they tend to be regulated, they tend to have stretched balance sheets and don't grow as much as we like. On the flip side, or as a result, we are overweight industrials and consumers. So as very long-term investors that use a bottom-up approach, we don't really spend a lot of time thinking about market or macro outlooks, but we do foresee volatility as we've seen in the past, and we try to take advantage of that by buying stocks when they're cheap and selling our holdings when we think they're a little bit expensive. In terms of an outlook, we probably see mid-single-digit returns, given that we're kind of late in a long bull market.